Okay, good, good, good. All right, good. So let's start then. So trade wars. It's been a really interesting situation. The last time we had something like this was 100 years ago. It's something I studied at university as an economist, but it's very different to actually trade it. And it's definitely like an interesting situation because remember we had COVID not so long time ago, and that again was something we hadn't seen for like almost 100 years with the Spanish flu. So now we're sort of in the same type of space again. And it's quite straightforward actually when we think about it. But success in trading it would have been more related to if you could understand what was happening with Trump. So let's dig into that. But let's start a little bit by taking a step back and just do a little bit of an intro on tariffs. So what are tariffs? The tariffs are a tax. Yes, it's a tax. It's either paid by the person or the company importing the goods. Okay. Sometimes it's paid by the supplier by lowering their prices. I'll explain in a minute. But for example, you want to buy some hardware. Usually it will cost you like $100. But now, if you want to buy that from China, you would be slapped with a tariff of 30%. So now you need to add another $30 on top to get that good. And for some products with a small margin, this does not make sense because it just eats up all the margin. So the problem here is that some goods are easily replaced, like some stuff we don't have to get from China, for example, whereas others are not. And that's when it becomes expensive, because that's what we noticed is that certain goods and certain things that are produced in China cannot be easily replaced. The same way as we can't necessarily replace a Porsche, for example, German car, right? Can't easily replace that. So who pays this tax? And this is the interesting bit, because there's a lot of misconceptions there. So it could either be the supplier. So for example, the Chinese manufacturer, they might say, okay, you're my biggest client and I want to keep you. So I'm gonna lower my prices with $15. Then the importer would pay the rest, the 30, to make it 30 in total. Or they might say, look, I don't care, you just have to pay more. Now, they're not paying the supplier more. It's the fact that when the goods comes into the country that they need to pay that, and that money goes to the US government. So either the supplier can lower the price a little bit, so when they bring it in, they pay less, or it will be the consumers. And that's what we're seeing with places like Amazon, because places like Amazon, they're now showing the prices. You also have Walmart that have said they're going to raise prices over the next couple of weeks, because wholesalers like Walmart could, of course, bite the bullet, absorb the cost. So they might pay the $30. However, it's not always good. And if they do that, then it's going to impact their profitability. So you're paying it somehow. Either it's going to be the consumer that has to pay more for the same stuff, or it's going to be a company that has to pay, and they pay with lower stock market valuation, or in effect, just less profit. Now, in the best of worlds, sort of everybody would maybe pay a little bit, the consumer, the wholesaler, and the supplier. But again, it depends on what you're actually buying. Like, can it be easily replaced or not? Some stuff cannot be replaced, and some stuff just becomes too expensive. So then what happens is that there's no trading there. Now, we're always trading, all of us. You might not be aware of it, but we are trading. Even within an economy, people are trading. In my case, for example, I'm very good at hosting these type of presentations. I'm very good at trading, and I'm an economist, right? So for me, researching this topic, trading on the back of this and all that is super easy. So I'm helping companies like Thinkmarkets to make that a reality. Now, I don't know nothing about farming, and I'm not a particularly good cook, for example. So I go to the supermarket, and there I get my stuff. And when I want something really nice, I might buy something at a restaurant, which I do quite often, or I take food home. So what I'm doing is I'm doing what I'm specialized in. And then we have the farmer working with the supermarket, and then we have the chefs working in the restaurants. All right. That is some sort of trading, right? We're all specialized. And that is what's missing out here. Like if I had to plant my own veggies, cooked all my meals good, cook all my meals, then yeah, I would still eat, but it wouldn't taste as good. So specialization is important. And so with that in mind, I say, does it matter who pays? I say, no, it doesn't matter who much pays because the result is the same. It's less trade, or you introduce inefficiencies. As simple as that. It's not efficient for me to do my own tomatoes, do my own gherkins, uh, have my own cows. It doesn't make sense, right? Specialization is important, and the same applies here in comes to world trade. And what's interesting is that we know that these tariffs are harmful because we have actually seen this before. So in the 1930s, um, we had a law called the Smooth Holy Tariff Act. It was introduced in the 1930s. So at that point, tariffs were introduced and they were pushed all the way up to 20% on average. Okay. So what happened at that point is that it was a lot of agricultural products that were under tariffs. And what happened is that other countries said, okay, you're going to put tariffs on us. We're going to put tariffs on you so you don't get an advantage. So then what happened is that if you were in Europe, you couldn't sell your stuff to the US easily, and vice versa. So that means that suddenly everybody has to become an expert in something that they probably shouldn't be doing. And that again reduces efficiency. And back then, global trade drop was 60%, and this was by 1933. And the Dow Jones was already down before this, but then dropped another 80%. So total high to low was at 90% drop. So dramatic swings. And tariffs is not the only reason for all of this happening, but because the world was in such a bad shape because of the Great Depression, and this obviously didn't help, it definitely helped someone like Hitler, for example, to become the Chancellor of Germany in January 1933, because we know that the German economy was completely destroyed by then. So they needed to, make Germany great again, I guess. And whatever stuff we're seeing now in the world is echoing a lot of the stuff we used to see about 100 years ago, because people feel that they're being unfairly treated. Economic situation is not good, although of course it's not anything like that in the developed world. We can all eat, and most of us have a place to sleep at night as well. Anyway, you can see how things can turn really bad. So before we got that deal, so we got a deal with China, as you know, a couple of days ago. The tariffs were up here at 25.8, okay? So much higher than they were in the 1930s. So if you sold your stocks, or if you were short as this was unraveling, then I understand you 100%, because if this would have been at these levels, they literally would have crashed the world economy. And things are much more interconnected now when they were in the 1930s. So you can see what I'm talking about here, how devastating would have been. Now, the tariffs have now been reduced and we're at 15%. So if we look now, what actually happened then? So this is on Think, it's a NASDAQ 100 chart. So let's talk about what actually happened here. So on February 1st, the US announces tariffs on Canada and Mexico, and we're here. And then just a few days later, we had a 30-day pause. That, I think, was the hint. And I didn't really see it first, but that was the hint that Trump is not actually going to, he wants to sort of scare, but he doesn't actually want to follow through. Okay. Remember, the Canadians said, oh, if you go through on this, we're going to cut your electricity. At the end, he caved really quickly. So it didn't really go as crazy. However, though, a few days later, he announced a 25% tariffs on steel and aluminum imports. And then he increased here on March 4th imports on China from 10 to 20%. And bear in mind, even though they paused tariffs, there's still some goods that are under tariff from Mexico and US, Mexico, Canada, and US. Okay, then they will introduce this, and then the stock market continues to drop, moved up a little bit, and then he added 25% tariffs on automobiles and auto parts. And then we had Liberation Day, where they put 10% on everything, like a base rate, and then some other countries had a 74% tax rate, places like Vietnam, for example. So you can see how crazy things went really fast. And that's why the stock market was completely tumbling. And then here on, I think it was April 8th, they added 50% more tariffs on China for retaliating. So the total on China was now 84%. Now, if this would have been prolonged, like the reaction here by the markets, the reaction was 100% correct. They're increasing these tariffs and the market collapsed. So if you on the stage was selling, it made perfect sense. And I would not have gone and bought. Now, of course, what happened at the end is that a lot of billionaires like Bill Ackman and also Elon Musk, they all pressured Trump to announce a 30-day pause, okay? And now everybody's sort of at sort of 10, 20%. If we could have read into and maybe figured out that Trump would have caved, then that would have been a really good opportunity. I did have a friend of mine that actually said, look, there's no way he's going to allow the economy to crash and he's going to be pressured to do something about this. And that person, my friend, he actually had the courage to buy. I was laying low. In fact, I had been short a little bit via XRP. So via crypto, I was actually short a bit. But this would have been the perfect trade. Because he flipped really quickly as he did in the past. And remember, he had a mini trade war with Colombia for 24 hours, which again, he folded super quickly. So I think that was the key. So if you were able to read how quickly he would change, then yeah, this would have been a really good, successful period for you. If you were a bit like me, then you would have missed out. Not on everything though, because I did trade some crypto. I'll show you that in a minute. And then he exempted smartphones. And then he said here, well, we're going to reduce tariffs substantially on China. And then when that happened, the market started to buy stocks again because they were predicting that there was going to be some sort of agreement between China and the US. That actually happened on May 12th. And then as well, they had a deal between UK and US just here. Now, maybe something that could have provided you with a bit of a hint is this. So this is the US Treasury market, okay? This is the yield. This is what the US pays to borrow money on the market. So you need to look here on your left. So what happened here is when they announced on February 10th, tariffs on steel and aluminum, and as well tariffs on Canada and Mexico, then the yield here was close to, say, 4.5, and then it went down, and then it went up, and then started to go down. And then they added tariffs on China and a few other bits and pieces. So usually when yields go down like this, it's because people realize that there will be a slower economic growth. So the bond market was saying, okay, you're doing this, well, it might create inflation down the line. We think it's going to be a recessionary, and that's why we're buying bonds. But following Liberation Day, which we also continued to go down for 1, 2, 3 days, it all looked fine. But then they decided to add 50% more tariffs on China. And just the day before that, we saw this massive swing. So suddenly it went from 3.9%, and then it spiked as high as 4.6. And this is an indication that not only do we think you're heading into a recession, we think it's game over for the US as a country. We do not want to hold your bonds because we don't think you're going to pay us. Alternatively, you're going to have a wild inflation. And that is why we having that. So it's one of these two. Now we know from the currency markets, and this is the dollar index, we know that when the US increased tariffs on China, the dollar weakened. When they announced tariffs on automobiles, the dollar weakened. On Liberation Day, the dollar weakened. And when they added more tariffs on China, the dollar weakened. So what's interesting here is that people will be like, we had enough. We're not holding any of your assets. We're gonna sell your stocks, which they did, and we're going to also dump your treasuries, which they did. If you're from the UK, you might know that we had a similar situation maybe like 2 years, 3 years ago with Liz Truss. So she pushed, there was the Prime Minister of the UK. She was Prime Minister for just a couple of weeks before she was forced to resign. So what happened back then is that they introduced all these tax cuts, but there was no one paying for it. So then someone said, oh, who's going to pay for them? Well, if you don't know how to pay them, then bond yield's going to go up. And it costs every household in England, I think they were like at least 1 grand poorer per year because interest rates were up so much. And a lot of pension money was lost because of that. And this was his Liz Truss moment. This is what happened here. So it was all good, it was all cool until the bond market went crazy and it pushed to the upside for the wrong reasons. It's fine if it goes up like before here because people thought, oh, the economy is going to be better. That's fine. But when it goes up on this kind of news, then that sends the wrong signal. So what can happen next then? And what do we know? We know the following. Trump was playing really, really hard. He was playing with the world economy. But when he got what he wanted, when he saw people started to get really worried, he backed off. Maybe a bit too fast, but he backed off. He backed off enough before we saw the world economy come to a halt, effectively. The only issue right now that we're still here, we're still at 15%, which is a little bit too high. Now, the next talk, the next steps is that there's probably going to be a situation where the US is going to reduce tariffs on China to just 10%. And they'll do this because they're going to come to an agreement possibly on the fentanyl tariffs. So the US has 20% fentanyl tariffs on China. And what they're saying is you're helping to supply the ingredients for fentanyl to Mexico and to Canada, where the cartels are mixing this up and creating drugs. That's what they're saying. But if they can come to an agreement on this, then possibly we can go down a little bit more. We'll still be sort of at 10%, which is still higher than before, but at least not as bad as it is right here. And with that in mind, if that will happen, as well if we have a deal between the EU and the US, and that will hopefully happen soon, then we could possibly see new all-time high in the Dow Jones, Bitcoin hitting 120K, maybe 130K. Oil prices, I'm not so sure about them. And EURUSD is a little bit tricky, but realistically, I think EURUSD is going to weaken because what's interesting here is that they did a trade deal with the UK, right? Now that trade deal still has reduced the tariffs on the costs and sort of things that were at 25%, right? They reduced that, that's fine. But everything else is at 10%, which means that if they apply the same across the world, then realistically, they will have some sort of inflation in the US. And that means that the dollar would need to take the adjustment on the back of that. So I still think it might potentially see a bit of weakening in the dollar. Now, in everything else, again, Nasdaq 100 probably up, Bitcoin probably up as well. I think that's good. It is what it is bullish, right? And gold as well, probably higher. So we'll see more of what we're dealing with so far. And what's interesting as well, I wanted to show you this. This is retail sales. This is the annual change. So this is what we looked at from last year. So you can see that retail sales is growing at about 5% per year, and we haven't seen any dent in this on the back of the tariffs. And the reason for this, I think, is because all these companies, like Apple, for example, they brought in a lot of iPhones before the tariffs kicked in. And now they have maybe stock for, I don't know, 1, 2, 3 months, and then afterwards they need to probably start to raise interest rates, prices, and that could probably impact this. How about the non-farm payrolls? So the non-farm payrolls fell off a cliff, but still at a healthy level. The last reading was about 180K, before that as well. So we haven't seen really any impact. The only thing we've seen some impact is on the PMIs. So the PMIs, which are leading indicators, dropped quite sharply here, and we're going to have another set of PMIs, so updates for May, and that's happening on Thursday, actually. So you definitely want to keep an eye on this, and I think that might be the next step in the equilibrium here. For now, the economy and all is doing okay, so people keep on buying stocks because they think it's going to be a better deal for China and there's going to be a deal for the EU. Okay, that's what people are looking at right now. So with that in mind, I think we still want to be buying stocks, still want to be buying gold, still want to be buying crypto on the back of this news. On the other hand, at one point, it's really difficult to guess. If the data starts to come out really bad, we want to sell, looking for this to these trends to fail. But that's where we have stop loss orders, right? We want to manage that, and I'll show you that in the charts in a minute. So here's the Nasdaq 100. So in the short term, so I'm talking about just in the next week or so, the very short-term trend is bullish above 20,596, so 20.6 more or less. And between 20.6 and 20.9, I think people will be quite keen on buying, as long as those PMI numbers that come out are not horrible, and then targeting the all-time highs. The alternative is that if the data does come out a bit weak, then we might drop to maybe like 21K or so. That's where the 200-day moving average is, and also this high. But I think around 21K, like this whole region here, from a long-term perspective, is really, really interesting. Okay, super interesting. So just to let's simplify it. Let's simplify it. So for example, we have an entry at I don't know, 20,400 with a stop at 19,900. So you risk 500 points, and then if this then goes up to sort of 23,000, then you can easily see that you're getting a substantial return from a relatively small risk. That's what we look at. This is called the risk reward ratio, and that's sort of key. So I would say as long as trade above this cluster here, we definitely want to be buying in the Nasdaq 100. In the case of Bitcoin, it's even more straightforward. So you have a very nice resistance level here at 107K. We tried to push above here just on Sunday, but it didn't work out. And it's good. I love this because the more a level stops the price there, the more important does it become. If this trades sideways for another week or 2 weeks, it will be an amazing breakout whenever this happens. It's just going to break here. Before you know it, it's going to be at 112K, 116K, 120K. And the cool thing here is that I usually buy, and then I put a stop loss just below the breakout candle, and you get like amazing risk reward ratios. Now, say data on Thursday over the next couple of weeks is soft, we might dip, but I think between 92.8K and 99.4K, I think people are going to be really keen on buying. And if for some reason this level doesn't hold, then we're looking at slightly lower levels. The general idea here is that we don't know exactly if it's going to bounce from here or here, although it's very likely it will bounce from here. Okay, so it's always about the risk reward ratio. Like I'm risking this bit to potentially make that return. In the case of EURUSD, this is probably the most challenging of all of these, because the fundamentals are not straightforward. Like we know to some extent that the US government wants to reduce the spending, austerity. If you lived in Europe and UK, you know what austerity is. That can reduce economic growth in the US, and with the tariffs, again, add like a double whammy. And whereas in Europe, we're doing the opposite. The Germans are spending about 5% of their annual income on infrastructure projects. plus they all want to bulk up on their military. So I think here what could happen is that we could potentially break 112.96, turn short and bullish, so we go up, then down, and then realistically push higher. I have some long-term targets at 120. It feels a little bit like far off right now, but yeah, I definitely want to be long-term bullish. I would say above 108.79. Here are gold prices. So gold prices were stuck in a so-called wedge pattern, and as long as you trade below 3,270, we might reach 2,987. And I think from this level here all the way down here, so between this level and here, so you're looking at maybe like $100. To be exact, it's $87 risk. All of this is a really good buy zone from the trend perspective, because you got your 200 moving average coming in here. So if we would dip here, I think people are going to be really keen on buying here, tight stop loss orders, and then for this to go upside. My long-term target is $3,600 for gold. And here is Brent crude oil prices. So Brent crude oil prices has obviously been impacted by tariffs, to the extent that when we had these tariffs coming in, so when we saw the tariffs being implemented, it's going to really hurt the Chinese economy. And because of that, we're in a situation here where this market could potentially drop a lot. And oil markets are a bit more rational. So you might think that the price is going to go up, but the way they are traded reflects more what's happening in the economy in the near term. So what's happening here is that they continue to reflect the negative outlook on the back of tariffs. And there's a few other things happening here, like the Iran-US deal that can add 0.8 million barrels in oil supply. And then you have the Russia-Ukraine peace deal that might happen over the next couple of months that can add another $2 million barrels per day. So those combined can easily send the price down, to I would say $54 a barrel. So it's a bit of a different dynamics here. But in general, I'm bearish below 67.36, and yeah, I might go up a little bit. But I think if we're closer to 60 in the next 2 weeks, then that would be fair. So that's the outlook. So with the benefit of hindsight, we should have assumed that Trump didn't really want to hurt the economy. He just wanted to scare. This is now the time I wish I would have read his book, The Art of the Deal. Maybe that's what he would have said there. But yeah, he likes to bluff a bit like a poker player, and then he likes to step back. And so far, whatever he has done has not properly hurt the economy. That's why we're up at these levels. And there's a little bit more juice to it, where we could have a situation where they reduce tariffs a bit more. And then their plan is to take this tariff money and reinvest it by cutting taxes for people. So that's another reason to be bullish. Now, the tricky bit here, which we don't know for certain, is how is the market going to react on these tax cuts? And how is trade going to develop with these high tariffs at these levels? Because realistically, the baseline is 10%. We don't know that yet. But the general idea is that for now we buy, as there's still scope for them to come down a little bit more. And I would keep on buying on dips until we start to see that the system is breaking, the economy is slowing. That will be a nice time to take the foot out of the gas and be more neutral rather than looking to buy dips. And that's my take on the market, and that's my take on trade wars. If you have any questions, now it's time to ask. I'm going to see as well if I can get the chat up. So we have the chat. We also have the Q&A, the question bit as well. Also, out of curiosity as well, we're going to run a poll. What would be good, actually, I wanted to understand if the level of details in the content was suitable, if it was too basic or too detailed. Let us know. I think the easiest is leave it in the chat. There's no questions, we'll just wrap up, but we'll give everybody another minute or two. We can write in the chat, okay? So I don't think you can write in the chat. So you can't submit questions. Here we go. What are your favorite markets? Did we cover them? Yeah, I can cover gold again. So let's see here. So in the case of gold, so we're really in a long-term uptrend. We can see this because we have the 200 moving average, and there are some patterns. So this actually triggered already like a year or so ago. I think it was March last year. Back then, we're trading at much lower levels, and I said it was time to turn bullish. And we're about to approach these levels because we might be at all-time highs, but if you adjust for inflation, we're still below the all-time highs from the 1980s. Remember, everybody tells you to buy gold and it's always going to be a safe investment. Well, people that bought in the 1980s have still not get paid, even if it's been 45 years later. So if we adjust for inflation and everything, on top of my head, we can go to 3,600 or so. And what's also interesting from a sentiment perspective, while there's a lot of people buying, it's not the craze like you see, for example, in crypto. People know they should buy and want to buy, but there's one thing saying, it's one thing doing it, and then there's the other thing of wanting to do it. So I don't think we have reached the peak yet. Now, of course, we're seeing quite a lot of wobbly situation here as well. And from a technical point of view, we're creating lower and lower highs. And on a break to 3,270, we would stop to create those lower highs. So then we would probably push up, push down, and then probably resume the uptrend. And something you can see as a trigger could be this Thursday's PMI figures, because it could be a situation where we have weak numbers and then people start to worry about recession risks and people might start to buy a bit of gold again. Until that happens, we'll probably trade sideways for a little bit. And from a wedge pattern perspective, so we triggered a wedge here. It was doing all right for a little while, and then it went up again, and then it went down, but it hasn't really resumed. But it also hasn't been disqualified. So to disqualify, to negate this pattern, we need to trade about 3,270. And until we've done that, we can actually just drift to the downside like this. Okay, good. So it looks like we don't have any more questions here. So we're going to wrap things up. I hope you enjoyed it. If you have any questions about Thinkmarkets, how it works to trade with them, feel free to jump on the chat on the homepage. I still have a minute or two if you want to have any questions on that. If not, what we'll do is we'll wrap up and wish you all a good afternoon, good evening, depending where you are in the world, and hopefully see you for the next webinar.